Good day. Ira Epstein of Linn Associates with your financial market review. And this is for Monday, the 22nd of April, 2019. We're just after 4:15 p.m. Central Daylight Time. A very mixed day. The Dow was lower, the Russell lower, but we had gains in the S&P and the NASDAQ. Keep in the back of your mind where we're at. This is a big earnings week. You're going to get a bunch of numbers in all kinds of sectors. It's going to move the market all over the board. You know that today one of the events that took place, of course, was President Trump, through the administration, Mike Pence, came out this morning and said that all waivers for the 8 countries that had still been getting them from the U.S. for Iranian oil will be ceased on May 2nd. Now, how countries react to it, what they do with it, your guess is as good as mine. How it gets enforced, what do you do with oil that was bought before May 2nd? Is it still allowed to be shipped? There's just a lot of questions with this. But the one thing that they've been making clear is that they're not going to extend waivers after May 2nd. My guess is that oil that was purchased or is being purchased beforehand, till that point, can still be delivered, and after that it's over. That's logical. Do I know that that's the case? I don't. All right, so we see the dollar a little lower, currency's a mixed picture, metal market's up a little bit on this. As you can see, the stock market's sitting, and it's sitting against all-time highs. 29.34 is the highest close. You're at 29.1260. Which way did the earnings kick the market is probably on a lot of people's minds. So far, the chart action, it's still bullish. It is not bearish. When you take a look at the sideways action, is this the consolidation? That's what I'm beginning to ask myself, because the market's not breaking down. Now, if the market were to break down from here and looking at the swing lines, what would have to happen is taking out a 20, this would be actually the low that has to be taken out, 28.8950. You can see it right over my shoulder here, and that was Thursday's low. As long as you didn't first make a higher high on the move, that could give you the pattern of lower highs, lower lows. Let's assume the market rallies from here straight up and goes through there at 29.2350. You still have then the pattern of a lower low, higher high. It's easier to get a bear pattern than a bull pattern. But where comes in the moving average support? That's the question. And it comes in, if you take that out, at 29.8270. So 75, let's round it to. So there's not a lot of downside before you hit your first layer of support. Nothing is saying that it has to find support at that number, but often the first challenge, be it to the upside or downside, seems to stall just a little bit at that number. And if you go back and you do your own work, you'll see that more times than not. Nothing is all the time, but it's something I'm looking for there. In terms of resistance, we really haven't hit the Bollinger tops, which I consider a main resistance point, since back at this time frame. And that's all the way, if we come over here, if you take a look at it, to right through this zone, which was back on April 2nd. Then the market broke back a little bit, but if you look at it, it's crawled its way a bit higher. Not dramatically so, but crawled its way higher. Okay, I can live with that part too. In terms of momentum, as I wrote in my research report this morning, a key was not to close near 2,900, and you didn't. You closed near the high of the day at 29.1260, away from the 2,900 zone. Why the 2,900? I looked intraday when the market was pushing in that zone, and you were losing the embedded reading. If you lose an embedded reading, and embedded means that the slow stochastics have both of its numbers. They're called a K and a D line. The red is the K, the D is the blue. If the red number, the K, closes back under 20 after it's been over it for so long with the blue line, it often leads to price and the 18-day average coming together. It managed to stay bullish, not bearish. This is a better look as to how a bullish slow stochastic looks. Until the red line closes back under 80, I say the market continues to find buying support. I'll show you in the Russell, when you lose it, what happens. Here's the Dow. It is, even though down today, it's keeping that bullish embedded reading. So all these markets still look bullish. This is what happened when you lost, not happens, happened when you lost the bullish embedded reading. Lost it right through here. It often leads to price and the 18-day average making a run at each other, and I think you can see that's exactly what did occur. Also, you're in a downtrend in the Russell. You have a pattern of lower highs, lower lows. This market, instead of getting to the Bollinger Band, keeps having trouble at the gray dashed line, which is the 200-day moving average of closes. Now, one of the things I've been pointing out to you is a phenomenon I've been watching going over and over is that when you're hitting either the upper or lower Bollinger Band, the option writers, you heard what I said, not buyers. I think their option writers are coming in to capture premium. So as you're going down to the lower band, I think that some writers of puts are coming in. Now, which one of the puts, I'll let you figure that one out. You're better at that than me. And when they do, I think they're trying to come out against the 18-day average of closes. Does it have risk? Anytime you write an option, actually I think it's riskier than a futures contract because when an option moves, sometimes they move vertically. And when they do, you don't get a lot of bids and offers in there until the market finds a zone where it finds itself in a good, what I'll call, where the buyers and sellers come back together. But I do think this is what's going on. I won't back away from saying that to you, and we'll see if that works. Does it always work? Take a look here. If you sold it there, it didn't come back to that 18-day average until at a higher price, and you had to ride out that storm. So nothing is perfect in trading. In the T-bond market, I see a downtrend still at work here. Lower highs, lower lows. That's my definition of a downtrend. Now, if the market were to take out 146.31, that is Thursday's high, you would break that. But this market keeps adding momentum. And the reason that I say that that isn't what I consider the real part of the market is because you have what we call an embedded reading. It's where both numbers that make up the slow stochastic are going sideways, in this case under 20, the opposite of what the stock indices are doing. And when that occurs, it's often a zone, if you will, a momentum idea that on these rallies, the pros keep coming back into the market to sell the market with the goal of trying to get to a Bollinger Band, a 100-day average, some number under the market. In the 10-year notes, it's the opposite. Notice how this market, if we come here to this close, this was Thursday. The numbers were not sideways under 20. They were here on Wednesday. They were under 20 on Tuesday. They were not on Monday. You never embedded. You need at least 3 days in a row of numbers under 20 or over 80 to have that word embedded. I created it, so it's my tool. And I didn't create slow stochastics. I created the idea of what embedded is there, ran it by the gentleman that created slow stochastics, who's no longer with us, George Lane, and we had long conversations because I became a real student of this oscillator. I liked it better than MACD and still do. It has a personality to it. In looking at TLT, the market's got a higher high, a lower low. It's not a trend, but this is what rules the day. On my hierarchy, slow stochastics, when they embed, are the strongest part of a chart. In other words, the strongest indicator. Everything else takes a back seat. So until this market loses this embedded reading by the red line closing over 20, I think the rallies are still getting sold. Another thing that happened on Thursday, this was the market on Wednesday, is you know my theory of Bollinger Bands. First time you hit an upper band or a lower band is where I think the pros take some money off the table. It's what I teach in my charting course. It's what I believe. Market goes up on Thursday, hits that number, and now it's starting to back off a little. Doesn't mean the trend isn't up. It is. You've got higher lows, higher highs, but I wouldn't be surprised if the market wants to backtrack a little bit. And if it does, we'll see, as long as it holds above 96.46 and that pattern remains, higher lows, higher highs, I'd look for buying support in the market. In the eurocurrency, I don't see a trend. I see a pattern of a higher high and a lower low. I don't see anything there, and I see a market that's right now sort of drifting against the 18-day average of closes. In the British pound, I don't see a trend. I see a higher high and lower low. I do see the obvious that each time the market has recently gone up to the 18-day average, it has found resistance against what I call that line in the sand. And now the question is, does the market find support against the 100-day average in green, or is it going to try to work lower to the lower Bollinger Band? It'll tell us. Again, I don't see a trend in the market. In the Japanese yen, as long as you keep the embedded reading, I remain in the bear camp in this market. Therefore, the question is, if it's staying in the bear camp, does it gain enough momentum to get down to the lower Bollinger Band? Should the red line close back over 20, I'd look for price in the 18-day average to come together. I will let that dictate market momentum. Bitcoin. Still staying over the 18-day average, which means an upside bias to me at least. I do see a pattern of not a trend with a higher high, lower low. Now the question is, does the market develop that embedded reading that's bullish with both numbers over 80 today? Both numbers were over 80 on Thursday, not so on Wednesday. That means it needs tomorrow to embed. Typically, markets don't embed, so the odds still favor that this market will try to pull back and the slow stochastic indicator won't keep both numbers over 80. If it does, I get bullish. This is the result of partially today. If you take a look, you closed at 790 on the differential between Brent and WTI crude. That differential jumped today 60 cents as what the president did with barring oil sales from Iran to 8 countries goes into effect on May 2nd. It puts Brent, not U.S. crude, at more of a premium to the U.S. You can see how the June Brent went up to the upper Bollinger Band. You know my thoughts. When the market hits that number at first time, I look for the pros to do some coming out. Does it always stop the market? Certainly not. Nothing always works. But this is the more important part. You've had that embedded reading, which is just bullish as can be, and the pattern of higher lows, higher highs. In WTI crude, you have the bullish embedded reading. Now the question is, do you get to the resistance of the upper Bollinger Band? Again, the higher low, higher high, and this rules the day, the slow stochastics, in my opinion. Gasoline did again what we had talked about. I think that after you hit a Bollinger Band and you pull away from it, if the market stays with the embedded reading, that play could come alive again, and that's what it did. It went to the resistance point, stopped there, and in that gas, what you finally did is you got back over the Bollinger Band. It is still in a bear market as defined by the slow stochastic being embedded, but you had 1, 2, 3 days underneath the Bollinger Band. This day it closed literally right on it. So it gave the market about a 2% chance to the way that I count Bollinger Band study of staying below that band. I count successive days of being over or under a Bollinger Band as taking away each one of those 5%. The logical question is what happens on a 6th day, because it does happen. Just a sign of more strength. You're not trying to go long if you understand Bollinger Band theory against that band. You're still bearish. The longer it stays under it, it's just telling you how weak the market is. I discuss this and a heck of a lot more in my written and oral and video commentaries. And if you haven't seen what I do, I'd like to give it to you for free. It's that simple. I'd like to give you a couple-week free trial to it. No credit card required on your part, no money required on your part, no commitment on your part. You start off every morning with my morning subscriber video. I cover 40 charts there with 5 ETFs typically. Then I write the commentaries, at least 2 a day. I write them Monday through Thursday, 1 Friday morning, 1 Sunday night. You're going to get what I call my daily numbers. You'll learn what that is once you sign up for this. And then audio commentary. Some people want to hear my commentaries that I put out about 11:30 in the morning, and I'll give you what I'm seeing in the market. I'm talking to you about it. And then again about 8 at night, that comes out. How do you get a free trial to it? Just call my staff. You can also go to our website and sign up for it there. You can also click right here. If you're watching me on YouTube, it'll take you to our website. On our website, we have a carousel of free offers. Click on it, choose what you'd like, and we'll get it in your hands. I'm Ira Epstein. You have a great day, and I'll talk to you tomorrow.